think everyone is here. Maybe we can start. Yes. So hi everyone, thank you for joining us on the last presentation session. Today we'll have the presentations of Miquel Bassart, Steffen Murau, and Francesco Ruggeri. So let's start with Miquel Bassart with his papers towards an endogenous public security supply framework. So please, Miquel, do you have a presentation to share?
Hi, can you hear me?
Yes.
Yes, I do have a presentation. The thing is, I'm connected with two devices at the same time. So to put my presentation, I guess I will have to have the control in the other device where I'm not speaking with. So I don't know if it's possible to have it from here. How can I have the control to share the slides?
Miquel, maybe you can just tell me what the name of the second device is, because I only see you showing up once.
I see. It's also Miquel Bassart, Loré. It's it has my name.
Okay, I think I just made you co-host. Just confirm that.
All right. Is it visible?
No.
No. Let me see. Share screen. Yeah, got it. All right.
So I'll just let you know when you have like 5 minutes left, okay?
Perfect. Thank you. Wait a sec. Okay. So, well, first of all, I'm going to introduce myself. I am Miquel Bassart. I am a master's student in the University of Paris. And this presentation is a reorganized part of my master thesis. The topic of my master thesis is an SFC model of how the US fiscal policy affects the portfolio allocation of institutional cash pools. This presentation outlines the social usefulness of issuing treasuries and institutional changes from the post-global financial crisis until the COVID crisis that are relevant for this matter. Okay, so the outline of the presentation is, first I'm going to present these institutional changes during this period in the US. Then I'm going to discuss about why is it socially useful to issue treasuries. Then I'm going to review Bassart insights on the crisis related to the issuance of treasuries before the global financial crisis, which he refers as a modern Triffin dilemma, and the hike in the repo rates, as what he refers in 2019 as a safe as declared. Then I'm going to present my idea of why I think the next step, a more efficient system would be an endogenous supply of treasuries, which is, I believe, consistent with the late institutional transformations in the US, excepting what happens in COVID time. And then I will just conclude. Okay. So, first of all, regarding commercial banks, I have selected two main institutional changes. First of all is the increase in the deposit insurance, which increases the demand for deposits in wholesale institutional cash pools. It has like two impacts. First of all, it reduces the demand for deposit alternatives, among which there are the treasuries, but it also increases the demand for reserves of banks, as they have to accommodate this increase in deposit insurance, this increase in deposits to be proportional with the amount of the balance sheet. And then we have Basel III, which basically increases the minimum capital requirements, and this tightens the survival constraint of banks, reducing the amount. Is someone writing in the...
Wow. No. I think it was a mistake by Kiko. Just let it be.
All right. Fantastic. And then we also have the mandatory liquidity provision, which also increases the demand for both reserves and treasuries, which it tightens both the survival constraint of banks and also, from the banking perspective, the monetary hierarchy, creating a higher preference for these instruments over the privately created deposit alternatives or securities. This is an evolution of the balance sheet of commercial banks, taken from the flow of funds of the US. And basically, we can see that there is an increase in the proportion of reserves. It used to be negligible before the global financial crisis, and now it amounts to roughly 10% of the balance sheet. We also have institutional transformations after the SEC reform in prime money funds. Here there are a lot. I'm not going to comment one by one, but basically it's a day portfolio allocation is now by law driven toward safer securities, among which the treasury stand as a main one. Repo collaterals are restricted to only cash items and treasuries, which also has the same implications in terms of tightening the monetary hierarchy. And then we also have that by law now they can have a floating net asset value, which makes a by law definition of shares of prime funds are different from bank deposits, which can be traded at par. Same as before. Now we also have the composition and size of the balance sheet of prime funds. We can see the amount of instruments qualified as other decrease. The amount of agency-backed securities do not increase heavily. During this period, they decrease also. And the amount of treasury securities have a great increase in 2019 that relates to the short day crisis that I'm going to comment in the next section. Now, regarding the Fed, we have first the strategy to target the interest rate has changed to a double floor system through the interest rate on excess reserve for a selective group of commercial banks, which is a soft floor, and the I think I'll have to quick a bit. Well, basically there is a double floor to control the interest rates. They wanted to target to go back to normality, they sizing the amount of the balance sheet by reducing the holdings in treasuries. But COVID made it back to wartime, forcing them to expand the balance sheet again. But this is just to show how effective has been this floor system. We've seen that there are two periods in which it could not control quite well, where the ceiling was not hard enough, and this is this period of contraction and then expansion back to wartime again. Okay. What is the social functions of treasuries? I have selected three. First, finance federal expenditure. Here I will endorse the critiques of modern monetary theory it is an institutional arrangement that the treasuries have to be first issued through an auction, and then these are traded in the private sector. But these auctions are commonly accommodated by the Fed through repo facilities. So it is essentially the same at the end of the day in terms of balance sheets as random ratios. It is essentially the same as an intra-Fed treasury transaction. So here I wouldn't say that the whole story is here. Then we have managing interest rates. I will defend that with the double floor system, it is still important that the Fed can have at its disposal, and in the private, in both sides, there is a stock of treasuries so that the Fed can do these open market operations. But I wouldn't say that the whole amount of treasuries respond to this purpose. And then what I believe is the actual social function of issuing treasuries is the macro-financial stability purpose of providing safe collateral and providing safe deposit alternatives, given that the deposit insurance is limited. 1 minute left. Okay, I will move quickly then. Okay, well, this is a graph that is in Pforr paper of 2013 explaining the Triffin dilemma, basically saying the institutional corpus will look for deposit alternatives, and if the treasuries are not sufficient, then they will create private alternatives that in a primitive system are not as safe. Then we have in 2019 the opposite. We have an excess amount of safe asset that cannot be accommodated because it was at a time where the Fed was shrinking its balance sheet and the banks had a lot of restrictions given the capital requirements of Basel III. So this translated into price hikes in the repo market, which were quickly cut by the Fed reaction. So I would, what I think it sounds is to accommodate the demand for safe asset and safe deposit alternatives by not by linking it to the federal expenditure and just make a a two-way facility with prime funds as centralized dealers of these safe asset and safe collateral, so that the Fed becomes a price taker and a quantity maker and a price setter, and the opposite for prime funds. Sorry for this very quick conclusion, which sounds as too much jump, but I'm afraid I exceeded the time. So I'm open to answer all the questions quickly if you have any. Thank you.
Thank you, Miquel, for keeping with the time, and I'm sorry to rush you up, but maybe we can go with with all the presentations, and then we have this, after the presentations, we have the comments, cross comments, and maybe questions from the audience. So we have time for everyone to present. So next one is Stephen's papers.
Sorry, Nathalie, can I just interrupt? I mean, I think I was told we'd be commenting on the papers. I don't know if everybody minds, but I think given how much there was in the paper, maybe just get those comments, because otherwise, maybe given that there wasn't actually a physical paper, I will forget some of the things I wanted to say.
Yeah, okay, yeah, that's fine. I mean, I just did it like this because since we have not much time, the last person who's going to present is perhaps going to have less time to comment. But if you prefer it so, it's okay for me. Everyone's agreed.
Sure, I will keep exactly to time. How much time do I have?
I don't know, maybe 10 minutes.
10 minutes. I will use even less than that.
That's fine.
Great. So, Miquel, I mean, thank you very much. So, I mean, as you guys heard, I don't think I'm not gonna summarize what Miquel just told you as a thing, but I'm just going to go directly into the comments. So I think the positive thing is, you really essentially tried to summarize a vast area of financial markets, both public and private, into a single presentation, and sort of you try to draw some conclusions to it. So I think I want to congratulate you on the goal you set yourself and what you tried to do. But I think ultimately for one presentation, it's a little bit too much, and I think you would do better to possibly focus on maybe less of the issues, and then really take the listeners through what you want to take them away. Because I think, what you did well, you clearly downloaded all the balance sheets, you made the graphs, you made everything, but you were so rushed that you couldn't really explain to us what we actually want to take away from the balance sheets. And sort of, my first gut reaction was, so you had this title, I don't know whether it was this one or current, but you talk about the endogenous supply of treasuries. And I just didn't even know, treasuries are obviously always given by the US government. What does endogenous do here, right? Like, whoever said that treasury supply was exogenous, like you couldn't control? Clearly the US government controls its supply of treasuries. They decide how much to auction. So what did you mean by endogenous here? And then the other thing that's sort of high level that struck me is, so in your title, it's about treasuries, but then in most of your presentation, you don't talk about treasuries, right? You talk about deposits, you talk about repo, which uses treasuries, but it actually wasn't so much about treasuries per se. And it was really quite tricky for me to understand what you thought treasuries were doing or what you thought they tried to do. So in your graph, when you showed the proportion of treasury was changing, just me eyeballing it, it looked, treasuries increased a little bit, but it didn't seem to increase so much. So I was a little bit struggling to see what you're taking away from me, particularly, your first slide. So you talked about deposits, and then you talk about Basel III, but neither of these things have to do with treasuries in the first instance, right? One is commercial bank deposits. One is about the capital that commercial banks held. Some of the capital they might hold in treasuries, but they might also use other things. So I really was a little bit lost how this all had to do with treasuries. And then obviously in your graphs, you had reserves, you had lots and lots of other instruments, and treasury was only ever one thing. So for me, the whole treasury got a little bit lost. The next thing, maybe I'm not an expert on this, but you said that the treasury auctions take place via repo. And my understanding would be that they don't take place via repo. You can roll over, banks can use new treasury auction maybe to take on some new debt. But my understanding was that the primary purchase mechanism wasn't through repos, but I'm sure there's somebody on here who knows this in more detail. And yeah, I think a little bit as well. So you have a lot of graphs to show how the asset compositions change over time. And I didn't really, again, right, draw out and help me to understand what you want me to take away from this. And I'm also, right, as you go to there, so you talk about the Triffin dilemma, right? And the Triffin dilemma, right, as it is, it's about a currency. So, it's about the US dollar and about how the, gold outflows traditionally, or even other outflows in order to stabilize the currency. Again, like, what is the connection to that, to the treasury market? Because obviously treasury and the value of the US dollar are linked, but again, it wasn't clear to me. So maybe these are just some things for you to think about, and maybe which you can clarify. And given that I don't want to run too long, Nathalie, I will stop here.
And that was fine, Tobias, thank you. But maybe since we just started the discussion, we can move it forward. I think Macaulay has a question also.
Thank you. I appreciate the presentation, and I guess I would like to introduce the distinction between a sort of elastic supply of treasuries in normal times versus in a crisis. And as I understood the proposal, it was for an elastic supply of treasuries in normal times. So that's a new thought to me, I'll admit. The elastic supply of treasuries in a crisis, which we saw in September, October 2008, seems to me to be the modern version of the lender of last resort in some sense. This is treasuries is what everyone goes into when there's a run. And so when they were going out of bank deposits in 2008, they wanted treasuries. And it just so happened that the Treasury was able to issue a lot of bills in September, October of 2008, precisely when all the world wanted to hold them. And that seems to me to be, in fact, the modern way of handling sort of a bank run, or more broadly, a financial crisis. So it seems to me an elastic supply of treasuries in a crisis makes a lot of sense and accords with experience in 2008. But I'm not sure what to make of the proposal that there be an elastic supply in normal times. And I might just say that the British have a nice phrase for this. It's called overfunding. And so it's when the Treasury issues more debt and more bills in particular than it needs to meet the public sector borrowing requirement. That's what you're proposing, as I understand. So the term of art in the literature for this is overfunding rather than endogenous supply. Just a thought.
Yeah, thank you, Robert. I think we have Alex raised his hand. Maybe you want to also ask something?
Yeah, so I liked this talk. My interpretation was similar to Bob's, that essentially what you're trying to do is set the price of treasuries, and then the government will issue or buy up treasuries in order to get it back to the price that you want it. So in that sense, the price is exogenous, but the actual quantity is endogenous, and it adjusts based on where you need to set the price. And you're imagining that treasuries are a deposit substitute. People, put their savings into treasuries. It's a safe deposit substitute. Back in March, Perry talked about the Corona crisis, and at that time, like Bob was saying, usually when there's a crisis, people run to treasuries, but people were being forced to run into cash. So then that blew up the yield on treasuries. So then there were too many treasuries out there, and they needed to be converted into cash. So in that case, if you have this endogenous treasury system in place, the government's going to just automatically flood the market with all the cash that it needs and suck up all the excess treasuries, and you're not going to have this blowout in yields. So that's kind of how I interpret it, and it goes both ways, right? They're the dealer of first resort in treasuries, both if there's too many out there and if there's not enough out there. That was kind of my interpretation, and I really liked it. I thought it was pretty straightforward.
Maybe you want to respond very quickly, Miquel, to those comments?
Yes. First of all, thank you for the comments. I will start with yes, I agree. Since I didn't have that much time to explain, maybe a lot of points were unclear, or I've been imprecise also in some words. I agree with the title. Instead of endogenous, the proper word would be inelastic. Regarding first, what is the effect of these changes in banks? It was more about what institutions should be in charge of accommodating this demand for treasuries of prime dealers. And I would say that since these are given these institutional transformations, perhaps banks cannot really accommodate that, and this was kind of a link to support that instead of the prime funds just accepting any random like connected to the treasury, to the federal spending, instead of accepting these volumes of treasuries going out without the public asking that, I thought it would be like, since they cannot accommodate that, I thought it would be much better if the supply is inelastic. They will ask it from a dealer of last resort and from a lender of last resort and a borrower of last resort, also setting the outside spread. Then I see. Yeah, if it's normal time or work time, I think it makes sense to me, given these institutional formations, that it's also in normal time, in the sense of there is already this tendency of being much more with this double floor system, and being much more interventionist in the outside spread. And since it's happening anyways, like with the purchase programs, with the floor system, that there is this target of the interest rates, and is it going to happen anyway? But with other channels, that the Fed is going to control the outside spread. I think it makes sense to me that they just quote the prices directly, and it's the private sector who decides the quantities. I think it's a much more effective way. And regarding overfunding, here I will just come back to the quantities. It will be the funding that the private demands at the price that the Fed sets. Not, it will be overfunding if the price they set is bad quote. But these errors in how to quote the prices can also happen now without an inelastic supply, and can happen in any case. So yeah, that will be my comments.
Maybe just as a quick response, I mean, the Fed doesn't set the price on treasuries, right? The market, the auction sets the price. Obviously, it gets influenced to the short. I mean, maybe, so, you know, when I see your graph, you had quantity graphs. So for me, when I see quantity graphs, I expect a quantity discussions. If you show me spread graphs, then I expect a price discussion. But I mean, one of the problems sort of I had in sort of following you is you show quantity graphs, but you talk about prices, and obviously they're related. And then sometimes you talk about quantities, but you have prices in mind. So for me, just to understand, to follow the argument you want to help, it would help me if quantity graphs, you talk about volumes, and spread or price graphs, and you talk about prices. And then for me, I'd find it easier to follow your argument.
I take that on board. Totally understandable. I agree. Maybe the intuition was not that clear, and it would be much better if I done it that way. So yeah, take that on board. Thank you.
Yeah, I think we had a good conversation here. I saw that Karen has her hand raised, but maybe you can leave it for the final part. We can go back to the next paper and have the discussion, or I don't know, maybe Karen, if you want to make your comment, maybe it's not that long.
Yeah, thank you. I thought you would be talking about the endogenous, exogenous treasury bill question in terms of new treasury bills or government bonds issued in order to finance, directly finance the budget deficit, whereas the endogenous supply is sort of the daily operations of existing treasury bills that can be repoed and, I don't know, swapped and borrowed and lent and everything. So please clarify if you make any distinction between these two phenomena.
Sorry, I'm afraid I didn't understand the question perfectly. Are you saying, just to understand it, if I make a distinction between the issuance of treasuries, the response to like federal spending, and the issuance of treasuries that responds to open market operations? Is that the question?
Yes.
Okay. Yes, I am making the distinction in the in the presentation of why are treasuries issued, I said that early these two reasons are happening, and then it is socially useful. Okay, sorry, rephrase. The currently why these treasuries are issued is because of these two reasons. What I think they are useful is because of macro-financial stability, of satisfying the needs of institutional cash pools and institutions that are financed by secured funding. This, for me, it's the socially useful function of treasuries. I think that it will be much better to subrogate the issuance of treasuries to this function and delink it from the federal spending, only from the federal spending. In case of open market operations, I don't think that explains the whole story of the issuance of treasuries. I think it's just a small part, except for which is wartime. I don't know if I explained myself correctly.
I think it was good, Miquel. Thank you for your replies. So now I think we can move forward to the next presentation. So please, I think, Steffen, are you going to share your presentation with us? Yeah, there it is. So after that, Francesco can make his comments on your paper. Thank you.
Name is on the screen.
Can you all see it?
Yes.
Okay, perfect. So I have 10 minutes, I understand, right?
I'll let you know when there's 5 left.
I'll see you right now, so maybe you can just say if I have 5 minutes and need to finish. Yeah, so the presentation that the paper that I'm presenting is co-authored with Toby, who has just discussed, and Fabian, who's in the call as well, called The Hierarchy of the Offshore US Dollar System on Swap Lines, the FIMA Repo Facility, and Special Drawing Rights. So it's, how does it work? It's a quite good timing because we've actually just launched it. So this week, we haven't really advertised it yet, but it's online. It is part of, I mean, we all come from different angles, I guess, but so from my point of view, it's part of my current postdoc project, which is with Perry at the GDP Center. And it is the second part of a trilogy, what is about to become a trilogy. So in summer, I wrote something on the Eurozone architecture. Now this is more on the global financial architecture. And the third one, which is due in November, because then the postdoc ends, will be on the transformation of the Eurozone architecture. But so what these 3 pieces are about is really using hierarchical interlocking balance sheets and like trying to map a broader system. And I'm sure in this crowd, everybody will understand what and why that is. And for the second piece, we want to look at ways to supply emergency US dollar liquidity from the Fed to non-US central banks. And we say there are basically 3 standing mechanisms, and we try to map them within interlocking balance sheets. So the motivation a bit, well, so one point was that so after the first paper where I wanted to already put in these special drawing rights, the SDR system, I decided to cut it out and put it into a new piece. And I was working with Fabian and Toby. We were reading like Zoltan's global money notes. This is when the FIMA Repo Facility appeared, right, in March. And we were thinking how to frame it. And we had the idea for some papers. And one issue that I came across is this idea of international hierarchy. So we all, from the MOOC, we all know, well, hierarchy in the dollar system. And Perry has also written on like international hierarchy. But there are different strands. So not just the Money View uses it. So there are some traditional IPE publications. We heard about Susan Strange on Friday. I think Professor Schenk mentioned her. She has a conceptualization of international currency hierarchy, and there's Cohen who has it, but also, I don't know, post-Keynesian scholarship uses it. So there are a lot of hierarchies, but there's no good explanation for it so far. At least I also came across it in various like reviewing processes for papers. So people if you have bought into the money view, you probably are fine with it. But if not, then people wanted to be convinced. So what kind of hierarchy is it? What and why? And we use a conceptual framework. I mean, I can go over this, but I'll just speed it up. So I mean, it's basically the money view with an idea for an application to international political economy. Since we all, Toby, Fabian, and I, we contributed to the special issue in critical macrofinance, we decided to go with that label. It takes very seriously, so I'm very glad that Bob is on this call. So this idea of the end of triple coincidence, which you see in the BIS in a number of BIS publications, and so this label offshore dollar system is something that I it's also very much in line with Perry. I started to use it a bit as a buzzword to contrast today's system. I mean, so the gold standard and the Bretton Woods system, they have good labels. The contemporary system often does not have one, and if at all, then it's generalized floating. And to put something against it, I always try to push this label offshore dollar system. An additional interest is to also clarify in the current international monetary system what's the relationship between the Fed and the IMF, and we also have something to say about that. Now, it's about hierarchy, and the question is, why is there a hierarchy, and how does it look, and where does it come from? And the argument we want to establish is to say it's a hierarchy of monetary jurisdictions, which is also a term that is connected to this end of triple coincidence literature. And in the first place, there's a hierarchy because it's a dollar system, right? The dollar is the key currency. We've heard that many times, which implies that private institutions outside the US use the dollar for international payment flows, and they need to create dollars offshore. But where does hierarchy come from now? And our argument is this is because of different ways how non-US central banks are able to access the Fed's balance sheet. And this is necessary in a systemic crisis because then the central banks need to replenish their FX reserves with dollar instruments to pass them on to their domestic banking systems. But this also creates some kind of an outside spread, which matters during normal times. And we say there are basically three systems in place: the swap lines, then the new FIMA repo facility, and the SDR system. Maybe the most interesting thing is the SDR system, because so what we attempted here was to put all three mechanisms in one framework of interlocking balance sheets, and getting the SDR systems into it was a really big challenge. Part of it comes definitely from me auditing Perry's course, where he writes about it, but then we also did quite a bunch of, we went through all these IMF publications and did interviews. But so this is the balance sheet architecture that the paper is organized around. And basically the whole point of the paper is explaining what you see here. I just want to say that there's a color code to it, right? So we have these three layers that depend on the three mechanisms, and the three mechanisms are integrated into those balance sheets. What do we see here? Well, it's outside, we have these monetary jurisdictions, so legal spaces that are connected to certain currencies, units of account. We have the US and the Apex, which is depicted through balance sheets and the hierarchical balance sheets. We have the Fed and banking systems, which is pretty straightforward and very compatible with the MOOC. And then complementing that, we have the US Treasury, and then a bunch of what we call off-balance sheet fiscal agencies. So like sub-balance sheets from the Treasury. And we look at two. One is the Exchange Stabilization Fund, and the other is the IMF. So it's a bit of a bold claim maybe to say that the IMF is basically a US off-balance sheet fiscal agency, but we think, at least in the context of understanding the functionalities of the offshore dollar system, we have some merit, or we can claim that. And then to look at the peripheral layers, we have the Eurozone and Japan, just examples. And here we just look at central banks and banking systems, and then a second layer, China, Russia, third layer, Bangladesh, Senegal. So what's the point? And so the way we represent these balance sheets is that so you have assets and liabilities. That's, I think, pretty straightforward. But then we have on the top, we have the actual assets and liabilities. So what you would report on balance sheet, and the difference between both is the equity capital. I think this is also quite straightforward. But then below, we try to list contingent assets and liabilities. So basically guarantees. So the ability. So we try to show which balance sheet promises to which other balance sheet to expand in case of a credit crunch. And the ontological status, so if these things exist or not, is really difficult to say. It's all very much subject to speculation, but this is an attempt to map that out. And it's obviously idealized and a time, like just a snapshot in time. But what we show here is that the first layer has access to, so central banks in the first layer have access to the Fed through swap lines. Second layer has access through the FIMA repo facility to the Fed balance sheet, but they need to hold US treasuries coming from here. And the third layer periphery has does not have swap lines formally and does not have enough treasuries to use this FIMA repo facility. So what they have is access to the SDR system, which goes, so the IMF is the one who administrates it, but if at all, they can interact with the Exchange Stabilization Fund, which acts on behalf of the US. And the Exchange Stabilization Fund then can establish the final connection to the Fed's balance sheet. So this is basically the idea of the paper and a way of framing international hierarchy. What I want to do now is just explain these three mechanisms real quick. Depending on how much time I have, I'm also happy to elaborate more. I can go on for ages. So if we think about swap lines, we look at the Fed and the ECB. So they exist as a contingent liability always, even when not used. It's the offer by the Fed to issue dollars as liability and accept euros as collateral, and the ECB does it the other way around. And if they actually do it, they hold deposits at each other's institutions. And this deposit then could, in theory, be passed on as emergency dollar liquidity to the domestic banking system in the Eurozone. If we look at history, we always plot here from 2007 to 2020. We have like three big phases, three crises when this was used. I'm sure you know it, financial crisis, Euro crisis, and now the COVID crisis this year. And we can look at the swap line price. And also we see that the prices often drop when they're actually being used. This is still relevant for our argument. So second, the FIMA repo facility was introduced in March. It's not really widely used, but the money view would say that's not so important because it gives an outside spread, right? So even if it's not used, it matters. The idea here is, I mean, you can show it a bit like it's similar to the swap lines, but instead of, so if we have here the Fed and the People's Bank of China, the Fed would not accept renminbi, but they only accept US Treasury bonds, with which the PBOC has to accumulate beforehand. And if that happens, they would get like emergency dollars, which they can pass on. That's why. So that's the point of the second mechanism. But it leads also to new dollar creation, at least overnight. And so, while for the first mechanism, it's quite easy to say who's part of that. It's absolutely difficult to say who belongs to the second layer periphery, because we would need to know how many treasury securities each central bank has, and this is not public data. We've looked around, and basically what we were able to find, the best we were able to find is this, which is just an aggregate overview on total US bond holdings by non-US central banks. It changes all the time, and then you also have to say how much is enough. So the second layer periphery category is empirically difficult to measure, but it still gives us an idea where like this kind of last resort dollar liquidity could come from. And then finally, the SDR system. So the way the SDR system works, I briefly alluded to it, and this is now maybe the most complicated balance sheet figure. So we have the Fed, the Exchange Stabilization Fund, the IMF, and then a first layer and a third layer periphery central bank. To understand how the SDR system works, there first has to be an allocation of SDRs. And allocation of SDRs means that the participants of the SDR system, which are peripheral central banks, here idealized, and in the US, the Exchange Stabilization Fund, they simultaneously get an asset and a liability. SDR holding is the asset, SDR allocation is the liability. You have to pay interest for allocation, you get interest for holdings, while you have the same amount of both. You don't pay any interest. So your balance, so the balance sheet expands. But so importantly, when there's an SDR allocation, not the IMF balance sheet expands. This is often being said, and that's just not how the system works. So those are the participants. Those are the instruments, so SDR holdings and SDR allocation. And those instruments are denominated again in SDR, and now SDR is a unit of account. So this makes the whole system also very complicated, that you basically have instruments that are called SDR, and you have also SDR as unit of account. Historically, for a couple of years after it was introduced, the SDR as unit of account was identical to the US dollar, and then it was replaced with a currency basket, and now it fluctuates. We found one IMF paper where they actually really say you have to explicitly disentangle between that, otherwise you confuse it all the time. So this is something we try to stress here. Now, we had the SDR allocation, and ESF and these central banks have SDR holding and SDR allocation. We can see historically there have just been 3 rounds of SDR allocation in the 70s, at the beginning of the 70s, then around 1980 and in 2009. And now drawing. So this is how you can actually get emergency US dollar liquidity, at least in theory. How it happens most of the time is that, so we now assume that this third layer periphery central bank needs dollars. And what they do is they sell SDR holdings, and they could sell it, that's usually what happens, to a first layer central bank. And then you see a shifting of dollars, and then it only gets recorded on the IMF balance sheet. So this is what happens most of the time. But what we're interested in is how is it possible to access the Fed's balance sheet for this third layer periphery central bank through the SDR system. And this is the second option. So here they get the liquidity. The second option is they would interact with the exchange stabilization fund. So they sell SDR holdings to the exchange stabilization fund, receive dollars for that, and then the exchange stabilization fund can issue SDR certificates, which have to be bought by the Fed. And then you see an expansion of the Fed's balance sheet, and then you can argue that really new dollars have been created by the Fed and supplied to this third layer periphery central bank. If this happens in practice, probably, if at all, to a very limited extent. Data availability is also restricted on that, but you can see how many SDR certificates the Fed has issued. It's, I don't remember, maybe 15% of total possibility. But again, we argue this provides an outside spread for the third layer periphery central bank. Here's some data on the SDR system. So you see those are the total SDR holdings that exist. You see how there was a new allocation. And so this line at the bottom, this is just how much SDRs were actually drawn in total by these SDR participants. Again, we did not have granular data on how much dollars were really drawn. This is also secret. And yeah, so this is a timeline. Just want to, it's also on the paper, but it often takes like 11 days an average for to get these dollars actually for a third layer periphery central bank. So it's really quite slow. That's why it's a really not an ideal emergency dollar liquidity provision mechanism, and it also wasn't made for that. So it's more our argument that this is just the residual that you have in today's system. We compare those 3 mechanisms with regard to limits, quantitative limits, acceptable collateral, flexibility of access, and cost of borrowing. Bottom line is that swap lines are always better than FIMA, than SDR. And I want to end with just a price comparison. So we had the price for the swap lines, and which is consistently below the SDR price, as you can see here, in crises. So they would always lower it when it was really used. And the FIMA repo price is very new. It's just down here, and it's basically at the same level as the swap line price. But as swap lines are typically longer term and FIMA is just overnight, you can also say in quantitative terms that, well, it's much better to have a swap line to get emergency dollars rather than having to resort to FIMA. And here I stop. Thanks.
Yeah, thank you, Steffen, for your presentation. It took a little bit longer, but I think that's no problem. You talk like for 15 minutes, but it was fine. I think we still have some time for comments. So I think Francesco was willing to comment on your paper, and then maybe we can move first to some questions in the audience.
Yeah, so I will be very quick. So first of all, congratulations. The paper is very clear, and the topic is really interesting, and I think it's really important to start to focus on these problems, because they both shows the complex network of balance sheet around the world, and that they work around the dollars. And it's very important even for political reasons, since we are facing now a huge problem that need fiscal expansions, and fiscal expansions are constrained for I don't know, third world country or developing country by the way in which they arrive to dollars, in a sense, how they can fund dollar spending for capital development. So it's very interesting to start to understand some way in which these countries can finance this final expenditure. So I don't have any critique on your paper, I would say, because it's, I mean, it's quite clear, and I agree with you. I don't have anything against your narrative. I will just stress a couple of points. I think it's a political aspect of the hierarchy, and maybe it should be stressed more. So who is what are the political reason why some central banks is accepted in the swap lines and other no? I guess basically the answer is political, the political jurisdiction or the political aspect of USA against other countries, or the political relations of USA with other countries. And so this is very interesting, because we need an evolution of these swap lines, because I think that they are the most flexible way to supply dollars publicly, I would say, without private agents. And the second one is the evolution, I will say, that you showed, because since the rise of the IMF, and basically for solve this kind of problem, so problem of balance of payments and of international currency, these two new tools, the repo facility, I will call it like this, and the swap lines, are two evolution from a really inelastic tool to give countries their access to dollars or other international currency, to a very elastic tools like swap lines between central banks that are very useful both in time of crisis, but in times even of huge need of fiscal shift, a fiscal expansion for real resources shift. So this is very important, and maybe you should stress it more in your paper, the fact that historically speaking, if we look at it from an historical perspective, we have a shift from a very inelastic period, I mean tools, to a much more elastic tool. And the second one, and this is a question, why you think that from the, I mean, if I understood well, we have first the IMF method to deal with these problems, then they arrive to the swap lines during the great financial crisis, and then they create this repo facility. Okay, so why do you think they switch from the repo facility, and they not enlarge, create more space for the swap lines? So why they switch? Because it's very interesting, since I'm working on the importance of governable debt in the economy, the fact that basically there is a tool from the Federal Reserve that enables other central banks that own the treasury bills to access to this repo facility. So it's very interesting that the Fed is leveraging the quantity of treasury bills in the world in order to supply liquidity around the world in stress periods. So I will stop here, and I will give you the chance to answer.
Can I just quickly answer, because I think I know some answers, because so the nice thing is, oh, what the nice thing, so in terms of organization of our work, we have said we will first write this GEGI study, as it's called, also to have this monster balance sheet, because I don't think, or I think it's quite difficult to get this published in a journal, right? Or because we're more flexible also with the format. But we want to turn this into actually a bunch of journal articles. That's the idea in the next time. And those articles are supposed to react to those questions that you've raised. So one of them would be indeed about like the evolution of the whole thing. So to historicize that. And a second one would be about monetary power. So in IPE, there's quite a bit of discourse about monetary power, and we think that this could basically more be the framework through which, so this is how the system looks descriptively, and now we can really get into it and find like elements of who decided on this, what would have been other options, and to, I don't know, figure out inflection points or something. But yeah, so it's basically the starting point to theorize on monetary power. And the third thing is the SDR system. So I mean, this interpretation that the SDR system is to supply emergency USD liquidity, I think that's maybe a bit the most daring part of it, because it's not really clear to which extent this happens. And what has to be said is that it's really not designed for that. So the SDR system was designed so that central banks can share like mainly dollar reserves, but I mean, usable currency reserves in Bretton Woods. And there was just a couple of years overlap, right, between the SDR system and the Bretton Woods system. And afterwards, the SDR system was called like a solution in search for a problem. And so this idea that this like small payment system with its very idiosyncratic accounting mechanism can actually be a bit like swap lines if you see it and connect the dots. Yeah, this is maybe just developing. So I think it's like a reuse of an existing institutional infrastructure.
I can also use my power as moderator to ask a question. Just to stress the point of Francesco of the political aspect, as you already said, you're going to write a paper maybe on it, because it struck my attention that you divided the second layer on people who has access to the swap facilities, and that is thus a political decision. And in a post-Keynesian perspective of the currency hierarchy, they label the hierarchy according to how a country can autonomously get access to dollar or to reserve currency. So I was wondering what is your point of view of that? So what countries should do, or what do you think is a better way to frame this layer, or to think what policies can countries do? Because if you have something that is merely political, it seems like there's nothing you can do. So I think my question is, what is the political or the political policy options for emerging markets?
Do we collect questions, or should I answer right away?
And maybe we can collect questions. We have a raised hand. So
I actually have a question just to come right in on that, if I can.
Yeah, sure.
Steffen, nice to see you. Nice paper. And I'm glad you said what you said in the end, in terms of, because you start with the aim of accounting for hierarchy, why is the system hierarchical, but then of course you don't account for it as yet. This is a kind of a prologue to accounting for it. It's still a description at this stage, right? But I think there's embedded in it the beginnings of an account, which is along the lines of what was just said. If you think of so the one balance sheet you have missing, of course, is the sovereign balance sheet. And the kind of concatenation of the sovereign balance sheet standing implicitly behind the central bank's balance sheet means that the economy itself is turned into the kind of reserve asset of the currency, right? That's actually the kind of, if the US economy is a bank and the Fed is a sort of the credit layer on top of that, then the kind of the capital in that bank, if you like, is US GDP. Now, of course, Europe has a similar sort of GDP size, right? But the European policy elites, and this is where the politics comes in, haven't or have different priorities, or haven't put together all that lovely plumbing that you just showed us, right? And I think that's where the politics is. The raw capacity is there in terms of the capital base, but the institutional plumbing has not been put into place. This goes back to Sangwoo's paper yesterday in terms of the decision of policy elites, and those decisions themselves are, of course, embedded in particular political settlements inside those countries. And so I think that is part of the question here, is that not just the micro politics, if you like, of how access, discipline, elasticity is distributed within the system that you've outlined, but the very decision to put the plumbing into place to begin with. That will to financial power, if you will, is kind of and of course that is an expression, as I say, of it's not like someone sitting there in a room twisting their mustache. It is an outcome of political contract, of a social contract that is brewing in different countries. But I think that is very important to understand in order to understand why this is a dollar system as opposed to a euro system or potentially a renminbi system. So I think that gets us to an account of the nature of hierarchy and why certain currencies can get in there, as opposed to a descriptive account, which is of course necessary but not sufficient as an account. Because then of course we will just be replicating what IPE does. IPE says, why is a system hierarchical? Because it's hierarchical. That's a tautology. That's not an account. That's merely pointing to hierarchy and saying there's hierarchy. So the politics of it, I was again just to stress what Nathalie said, is I think absolutely key here.
So I think we have a comment also by Robert Macaulay wants to step in.
This is very rich. On Steffen's presentation, as Kindleberger said in Manias, Panics, and Crashes, IMF credit is slow, conditional, and limited, and therefore basically unsuited for the lender of last resort role. So by contrast, the SDR allocation is not conditional, and you may like that or not. I remember talking to a Treasury official who said after the last SDR issue, Ukraine paid off a military debt to Russia. Did we really want to finance that? But it is even slower, 2009, and it is even more limited. So to me, it's not clear, despite all the effort you put into it, that it belongs in the same breath as the Fed swaps and repo facility. If I may go back to Miquel, so how do you respond to a flight into treasuries? And here we distinguish between pseudo debt management policy by the Fed, see my paper with Professor Ueda, and what the Treasury can do. The Fed, to the extent that it holds treasury bills, can sell them into the market and provide a supply into the bid for treasuries, which is the modern form of the run. But the Fed runs out of treasuries at a certain point and cannot produce them. And its own liabilities are not a very good substitute for treasury bills because they have a very limited clientele by construction. So at that point, the Treasury is needed to serve as the true lender of last resort. And that, I think, is the strength of Miquel's piece. Thank you.
Can I respond quickly?
Yes, sure. I think we have one more question. I don't know if you want to take them out.
Okay.
I think Ritwik has his hand raised.
Thanks for that presentation. I love the pyramid. I just had a question that there's another way for some of those national institutions on level 3 of the hierarchy, so the bottommost level of the pyramid, to access the Fed's balance sheet, which is through one step, which is a private dealer that has access to the Fed's balance sheet on the discount window can enter into an FX swap at a price. So it's not exactly par, but at some, assuming some credit risk of the central bank or of the government of someone on layer 3. Is that something that you see in your research? Is it something that you've seen happening comparable to better price than IMFSD, the current arrangement, etc.? Would be quite interested to hear your views on that.
Okay, that's a great point to connect with Nathalie's question. So Nathalie, you asked about like the post-Keynesian perspective and to get autonomous access, and also the last question refers to it. I mean, what we look at are really the last resort mechanisms that are in many cases not, I mean, especially in the SDR system, not barely used for that purpose. And of course, you have a lot of private mechanisms as well. And I mean, I guess you can optimize as a country by just looking for more favorable private first resort mechanisms. It's a term that we've introduced also upon Perry's suggestion. And yeah, sure. I mean, also third layer periphery, and central banks can use then such private mechanisms. Then Bob's point, if it fits in, yeah, I mean, I understand. So you could also say it does not fit in because they are so different. But I guess one point, so first of all, empirically, you can see that there are really some least developed countries who have used all their SDR allocations for different purposes. So it's for a big dollarized country, monetary jurisdiction, it absolutely is negligible, the SDR system or the amount of dollar liquidity you can get there. For some small countries, it still matters, at least, or can matter, at least. I would say this is true. And then again, what we also show is how it's not a very good mechanism for that, right? So it's just what is there. So in that sense, our attempt to put it in line is also to just show the deficiencies of that remaining mechanism. And then finally, Anush, you've raised a lot of points, and I'd be happy to discuss all this with more time. I mean, so one thing is hierarchy. What does it mean? So hierarchy obviously has also a normative meaning, and in IPE usually often is used in normative terms. The idea here was to find just like at least a thin argument to really pin it down empirically. What does it mean today? And I think this is also something where Perry and the money view literature so far, at least, has not stressed that, at least from an empirical standpoint, and that we can really discuss who belongs where. So to be more granular. So that's really the idea. So hierarchy through different mechanisms from central bank to reach the Fed. So that's the starting point. And here I hope to be at least a bit more specific than much what happens in IPE. And as I said, power comes in next. Maybe it's better to talk about power than really, and not mix hierarchy with power, at least. So I would prefer to keep it more as a descriptive term, but I know that, I mean, probably it's difficult to find agreement on that. And then your second point was to bring in the sovereign balance sheets, and I totally agree. We only have the US Treasury in it, right? So we had a version where we had also different peripheral treasuries in it, and we decided to drop it. It gets too complicated. And then the whole question of how does the central bank balance sheet and the treasury balance sheet, how do they relate in this framework, right? This is just so much work in progress. And I guess there are different, so we're still at the stage where we have MMT that basically consolidated and say that it's just the state. And so I guess to just further develop this literature, yeah, a lot of work can be done on that. And then finally, you mentioned Europe, and this is a project on the Eurozone and that I'm doing here. And I mean, that's even more terrible, right? And even more complicated. And so what's the relationship between like European sovereigns? And then, I mean, so the argument that I'm pushing is, in absence of a proper EU treasury, you have just this proliferation of off-balance sheet fiscal agencies in Europe. And you only understand how Europe functions if you look at all that off-balance sheet stuff that is going on there, right? And how you fit this then in this global hierarchy of the dollar system, I don't know. So that's again the wish for a total theory. And I mean, yeah, I guess to just get something out and finish something, you also have to narrow down the questions and yeah, do it bit by bit. Thanks.
Okay, I think we don't have more questions here. We can move to the last presentation. So Francesco, his paper on yield curve control.
Yeah, can you see my screen?
Yes.
Yeah, perfect. So can I start? Yeah, okay. So what I'm talking about today, it's a work that I'm doing since basically the start of the pandemic, and is basically on two different topics. One is the need for central bank to intervene in the government bond market, and the second is on one specific way in which the central bank can intervene in the government bond market, and so the yield curve control. I've started working on this topic since I would say, inglorious speech by Christine Lagarde at the beginning of the pandemic, when basically she said that the ECB wasn't there to close the spread. causing an increase, a surge of the spreads in the eurozone, especially for peripheral country, and then basically the need for the central bank to intervene in the market and close the spread. So at that moment, my question was, I mean, is it true that the central bank doesn't need to intervene, cannot intervene in the government bond market, especially in euro? And while the answer to this question is straightforward, is if we take in account just the fiscal stance, the fiscal need of the government, if we take the money view, I would say, we will find different reasons why we need intervention of the central banks in the government bond market, and specifically different tools than basically the standard lender of last resort or the quantitative easing measures that we have seen since the financial crisis. So basically, we have three different reasons why the central bank should intervene: the fiscal stance, the financial side of government debt, and then the monetary policy basically the monetary policy in the new financial world. The fiscal stance is the most straightforward, as I said before. Basically, when there are massive contraction of the GDP, governments must step in the economy and shift real resources from a sector to another. And so the central banks need to intervene in the market that is the financial condition of the government. And if we keep the money view lens and we see the government outflows as someone else inflows, we understand better why this easing of the financial fiscal stance of the government is already a monetary policy action by the government. Because if the central banks is the fiscal need of the government can expand its budget and cover basically all the everything, all the hole that you have in the economy when the GDP starts to collapse. So easing the fiscal need is already a monetary policy device that the central banks must ensure in this moment. But the need for central bank intervention is not just idiosyncratic or tied to one particular moment, so basically the recession, but it's much more structural if we look at the so-called evolution of the financial system, what we call now market-based finance or shadow banking system. Without going through all the techniques of the market-based finance, we basically can understand this new type of financial world as a markets organized around collateral lending. And so markets that demand safe and with low price volatility collateral. In this new world, the government debts are often used in repo market, in repo transactions, and basically they see the status upgraded to safe assets. So the liquidity status is upgraded to safe assets because of their nature, but because they are largely used in repo market. So basically, government are not just fiscal agent, spending and taxing and moving resources from one sector to another, but they are shadow agents. They issue a liabilities that is an asset for the private sector that is the cornerstone of the financial system. The problem with this safe asset status that is relies on the overlapping of two different concepts: moneyness and market liquidity. And these two concepts are different, while basically in some particular moment, especially thanks to the repo market, they become basically more or less the same things. But this safety is manufactured by the financial engineering behind the repo market and behind other financial contracts, and by the fact that by the ability of the assets that we are talking about, so government debt, to find an ultimate buyers that establish a floor to the price. So basically, this safe asset status that government debts acquire is basically constructed by the idea that there are a financial engineering behind it, and because there is an ultimate buyer, an outside dealers that is ready to step in and basically put a floor to the market. So in this environment, is really important to have a central bank that intervene in the government bond market, because basically it runs to this very important asset. So we arrive to the third reason why we need central banks look into the government bond market that is tied to the second one, and basically is the fact that monetary policy transmission nowadays, and so private, and especially private credit creation, relies on securities market and especially on government bonds, and monetary policy transmission basically work for a significant part through the balance sheet of agents that are not, they don't have direct access to the central bank's balance sheets and use collateralized borrowing to take position in the market. So basically the central banks that wants its monetary policy transmission to be effective must look at the government bond market and intervene, putting a floor when there is a run and when there is a high demand for liquidity. So, and basically central banks has understood that pretty well. If you read the last papers of the Bank of England, they speak about market maker of last resort, that basically the same idea of the dealer of last resort that Barry Mehrling talks about. And the idea is that the central banks can safeguard market liquidity, intervening in some particular market, not just government bonds, but even private securities like other kind of private securities, and basically become the ultimate buyers that put a floor and establish the minimum price at which the market will see in that particular segment of the market, and even a ceiling. So it can create a floor and a ceiling for the fluctuation of the price. So market maker of last resort or dealer of last resort is basically the future of central banking, the way in which central banking must start to adapt its policy decision nowadays and in the future. Now, yield curve control, I think it's a very good way to for a central banks to implement a market maker of last resort program. Why? First of all, yield curve control differs from quantitative easing policies because while quantitative easing entails a given quantity of central bank purchases of security from the private sector, so basically the central bank decide an amount and the period in which they want to distribute this amount and then start to do these purchases. And you can see this basically the quantitative easing policy as an hammer that the central banks smash on the yield curve, try to put downward pressure along all the yield curve, the yield curve. But this is costly in terms of the balance sheet expansion. So you don't know how much expansion do you need as a central banks. You may need little expansion of your balance sheet, or you may need years and years for stabilizing your yield curve in some particular portion. Yield curve control directly sets a target on price for a given set of bonds. So you decide with the yield curve control, you decide the type of bonds that you want to target, the price that you want to target, and then let the quantity adjust. So the balance sheet of the central banks in this case are free to increase or decrease given the price that you want to set. The powerful things here is that the commitment of the central banks over a particular target can be internalized by the market very quickly, and the target price can easily become the market price without a large amount of purchases. So basically, yield curve control is a mix of three different central banks policy: forward guidance, QE programs, and the corridor system. So basically, the central banks announce that will cap the yield and start the purchases with no limits on the quantity that he wants to use. This commitment, basically, once it reached the target of the price, the commitment to stay there and to continue to purchase once the price deviates from this target is basically like forward guidance. I mean, the markets know that the central bank is there to intervene once the price is gonna deviate from the target. So this is basically a strong commitment that can be internalized by the market very quickly. And then we have the corridor system, because putting a floor on or a cap on the yield or a floor on the price, basically the central bank is creating like a channel or a corridor system. Basically, when the price is going down, the central banks start to buy. When the price is going too up, the central banks can start to sell and put the price put downward pressure on the price. So basically, you have these three different policy in together in one instrument, in one tool, that is the yield curve control, in one program. So let's see now a couple of examples of yield curve control program in the world. We have the most famous one nowadays is the yield curve control in Japan. So Bank of Japan in 2016 introduces the quantitative and qualitative monetary easing with the yield curve control. And basically, under this this program, the Bank of Japan committed to fix the yield of the Japanese government bonds with 10 years maturity around 0%. The aim was to fight deflation. This program was made by two auction methods, the competitive auction method and the fixed rate auction method. The competitive auction method is the normal type of auction that the central banks usually do. And the fixed auction, fixed rate auction method is a very interesting tool. Basically, in this kind of auction, the Bank of Japan purchases at a fixed price an amount of bond in order to peg the desired yield. The amount of bond can be unlimited or determined in advance. So basically, once the auction starts, the central banks will say, okay, we are going to pay this price for an unlimited amount of purchases. And if for any reason the market is not willing to pay the price, the Bank of Japan will continue to buy until the yield level is close to the target. Now, the central bank creates basically a spread because the target is from 0.1 to 0.11, sorry. And so there is a little spread for deviation, which is very useful. So, and this is what happened since 2016 to the purchases of government bonds by the Bank of Japan and the yield. Basically, we have a decline of the purchases since 2016, and the yield was fixed almost at zero. So basically, the yield curve control allows the Bank of Japan to fix the yield with less purchases than a normal quantitative easy program. So now we can discuss about it. I mean, they do a lot of quantitative easing before the start of the yield curve control. So maybe the yield curve control was eased by the fact that they basically increase the number of government bonds they hold before the yield curve control program. But still, basically, it's the story of the Bank of Japan is a success in targeting the yield. A second example is the Reserve Bank of Australia that is fixing the yield on 3 years Australian government bond since the start of the pandemic. They fixed the yield at 0.25% on March. And then they basically announce a reduction of this target at 0.1%. And as you can see, since they start targeting the yield is stuck when they want. So basically, they are able to fix the interest rates on a particular set of government bonds and keep the rates at that point until they change their target. Now let's go to my home country or my geography. Okay, the European Central Bank. Since the start of the pandemic, the European Central Bank launched, create a new quantitative easing program. This quantitative easing program is different from the other one because it's very flexible. The European Central Bank can deviate from the capital key. And for a lot of analysts and commenters, this kind of program is a step close to a yield curve control, because basically the market knows that the ECB can intervene in the market and can purchase without any limits or the limit is on the quantity they decide, but this is a big quantity for now. So, but they can, the central bank can decide to increase, for example, purchases of Italian government bonds and stabilize the yields. A lot of people now are saying that basically the European Central Bank is closing the spreads, despite Lagarde said she wasn't there to do that. But by the way, the ECB, so my proposal for the ECB is basically to have a coordination between all the central banks of the Euro system and establish a range of fluctuation for yields for any single country. The range can be constructed around an average value of the yield of the pre-COVID year for every single country, plus or minus X basis point decided by the ECB. I'm not saying that basically this should be the perfect target yield. I think, for example, that the pre-COVID yield now maybe is too high, since basically the PAPP program has put a lot of downward pressure on the yield. So maybe we can imagine a Japan style of yield curve control, so to have basically more or less all these countries with close to zero spreads, so close to zero yields. But in general, the idea is to have a range of fluctuation. So the ECB enforce an upper and lower bound for the yield of the bond, standing ready to buy when the yield is above the target and to sell when it's below. So what is the main point here? That if you target the pre-COVID yields, you don't have to explain to the German central banker that this policy will have a permanent transfer, and so this yield will reflect basically the ability of the government to finance itself without the central banks, without before the COVID crisis. So it should reflect basically the strength of an economy. At the same time, with this spread, with this range of fluctuation, basically you force the national central banks to sell if the price or the yield will go too low. Sorry, the price will go too high and the yields will be too low. At the same time, you will have a positive impact on market fragmentation, because you will have an increase of market participants looking for positive yields for their investment in the peripheral bonds countries. So you will have less market fragmentation. So you will strengthen the Euro financial system and start to have basically more coherent monetary union and financial union. So let me arrive to the conclusion. In the new financial world, the role for central banks and its relationship with the government must adapt. If government bonds acquire moneyness and the treasury becomes a core financial agent, while it's pursuing its fiscal needs, the central banks must ensure a smooth functioning of the government securities along the yield curve. And so the central banks must act as a dealer of last resort. I think that an explicit target on the yield curve rather than a quantitative easing program is a powerful tool and must be considered as a possible policy for central banks that want to stabilize the government bond market. The strength of the yield curve control policy is that this mix of three different kind of central bank tools: quantitative easing, forward guidance, and the floor and ceiling system. So it will not be so difficult, at least technically speaking, for the central bank, for the European Central Bank, to turn the PAPP in a yield curve control target, explicitly putting a floor for the price of sovereign government bond in the Eurozone. So we'll finish here. Thank you.
Thank you, Francesco, for the interesting presentation. We have passed the limit, but I think we can keep up the discussion for another 15 minutes to have comments and discussion. I think Robert wants to ask a question, and then we can have Miquel's comments on it. So please, Robert.
I yield to Miguel. We should hear his comments first. Excuse me. Miguel?
I think
I'm fine. Comment.
I think it was having some connection problem, maybe.
Miguel, why don't you give your comments first? I'm sorry.
All right. Sure. Yes. Well, first of all, thank you for the presentation. I think yield curve controlling is kind of in the same direction of what I was going to in my presentation of setting central bank sends an outside spread, with the difference that this is a purchase program and I was talking about the facility. What my first question will be, what do you think will be not operation wise, but in terms of outcome, the difference between establishing a facility or defining this outside spread as a purchase program? And second, the question that I
Sorry,
have
I didn't get the question, Miguel. I didn't get the question.
Yes, I'm saying what this yield curve control, if I understood it well, it's a purchase program. It's like a promise to buy or sell in the secondary market, but it's not a facility.
Yeah,
is it correct if I understood it right? Okay. I mean, so basically, my first question is, in terms of outcome, if do you think there is any substantial difference between defining this commitment to set an outside spread as a facility or as a purchase program? Another question that I have is regarding this spread between the countries of the European Union. My question is basically why there is this spread between countries, in the sense of, you're saying that there is different solvencies. It's in the sense it will be not the European Central Bank backing up the debt, but the governments and its ability to get tax receipts. What is defining this spread? If so, why? That will be all.
Okay. So, what I can do? I will answer to the Miguel, or we can.
Maybe we can collect the questions, and then Robert is in line, and maybe if someone else wants to raise his hand to go next.
Yes.
So Miguel raised the question of sort of how to do it, a facility, a sort of standing facility versus operations with a schedule and so on. But I'd ask a slightly different question, which is who should do it? And again, I go back to debt management versus central banking. And you can imagine ECB policy setting the short-term rate, certainly the overnight rate, Euribor, but also sort of stabilizing the bill rates of the individual governments in the euro area. And then you could imagine each government sort of standing ready to buy and sell its securities. And if they were certain, by virtue of the ECB policy, of being able to issue an unlimited quantity of bills at, barely positive, or even slightly negative rates, they could basically control the 10-year rate by changing the government balance sheet, its liability structure, its debt management as between the 10-year and the short bills. So it's a question of, where should this happen? Should it happen at the level of the Italian Treasury, the French Treasury, or should it happen at the level of the Euro system?
I think you can respond, Francesco. We don't have other
Yes,
questions.
sorry. I mean, I have my cat that is now trying to kill me. Okay, I will. Okay, so for Miguel, I think that the difference in spread are a problem of fundamental. Let's call it fundamental. I mean, it's a problem of political. There are political problems inside different European countries. So, for example, Italy, that is one of the economically speaking, I would say, most important countries, had a high spread because of different reasons. I mean, there is political problems. There are structural problems on the spending of our country. So we have a lot of spending, not on investment and so on, built on the capital formation, but a lot of spending on securities, on pensions and other unproductive spending. I wouldn't call it unproductive spending, but it's how it's in Eurozone it's called. So I think that we have spreads in the Eurozone because of this problem. So this is not a facility. This is a program, and should be very clear. The European Central Bank should be very clear. This is a commitment to fix the yield at a certain level. Not always. I've read a very interesting blog by David Andolfatto. So it's I don't know if you know him. It's a chief economist of the St. Louis Fed. Basically, he called the yield curve control political contingent program. It's not a policy that you have to use every time, always. It's a policy that you use in some particular moments, a specific moment when you need to fix the yield of the government bond at a certain level, because you need the central banks to step in and to put a floor on the market. So the problem is how long it will this policy will last. We don't know. I mean, it's first of all because exit strategy from this kind of policy is very difficult. We have seen it with the quantitative easing programs. It's very difficult to exit from this policy. But I do think that with yield curve control, especially if you create a range of fluctuation, can be easy if you basically expand the range slowly in the year. So basically, like for example, you create a range of fluctuation between 0.1 and 0.11. Okay, so 2 years later, you can say that the range is slightly higher. So you can say it's 0.1, 0.12. Okay, maybe it's a huge shock, but you can try to increase the range, and so basically I have a smooth exit strategy. So Robert, thanks to my cat, I don't think I really get your question. So if you can repeat very quickly the point of your question, I can answer to you maybe.
So you have the ECB stabilizing the bond yields of the individual economies. And so an alternative is for the ECB to stabilize, say, the 3-month bill rate for each of the economies. And then for the treasury of each jurisdiction to say, here's our 3-year rate, or here's our 5-year rate, or here's our 10-year rate. And we will buy and sell bills and sell or buy notes or bonds to the extent necessary to hold the 3 or the 5 or the 10 or all of the above yields where we want them to be, so that the ECB role is not the whole yield curve, but just the short end, giving each government the near certainty that it can take in as much in the way of 10 years as it has to stabilize the 10-year yield. So then the choice of what yield node to target and what level for each node targeted is then a debt management decision of the Italian, German, French, Spanish Treasury rather than something that the ECB has to work out, God knows how.
Yeah. I mean, I think it's what is happening now. I mean, the PAPP is basically focused on very short-term liability assets, so government bonds. And for example, a month ago, I think, Italian government stopped issuing 10 years bond and start basically just issuing very short-term bonds, like 3 years or 5 years, because the European Central Bank is buying that kind of bonds. But I mean, for example, that's why I think that yield curve control is a policy contingent tools, because now we need long-term investment. We need the government to issue long-term bonds and finance long-term capital formation. So you need to build up, for example, the green transition. So it's better to have a policy that is targeting not all the yield curve, but a portion. So you say 10 years bond or 15 years bond or even 7 years bond. And so you fix the yield for that kind of bonds, and the government knows that basically can finance that kind of spending, that's long-term spending, issuing that kind of bonds. I think it is very useful for this reason, because it's good for monetary and fiscal policy coordination, especially in this kind of crisis, in which you need this kind of spending. I think Robert wants to answer again.
Yes, please.
I would note that the European Commission will be financing at what, 11 years, which of course is a bond node that no one wants, in order to finance long-term investment. So there's some of that coming at the broader European level.
Yeah. I mean, I don't know. I mean, I'm happy for this embryonal. I mean, the start of this fiscal union by the European Commission, but I'm afraid that the amounts are not enough. Is not enough. I mean, we are fighting the war against the COVID with our fiscal spending in Italy, and this is the same in other countries. So it's too little, and I hope not too late for the next generation EU, but I will definitely say that it's too little for sure.
I think we can have like 5 more minutes if someone else wants to comment or ask the question of any of the 3 papers that were presented now. No? Well, if you don't have more comments, I will just pass it to Jay. I know Karen just raised her hand, so please go ahead.
Thank you. Well, I'm a little bit puzzled by the presentation, because I think you sort of take the point of view that the central bank can ideally manage everything and then you are happy. Well, even if the central bank could manage everything, I don't think I would be personally happy. But I don't think it's our job to sort of give advice to the central bank and pretend that we live in a crisis-free economy. And my question is to that, how do you think that given the market reaction, you have not really discussed what's happening in private markets that also influence what's going on with the ECB treasury or government bond markets and how they monetize, et cetera, debt, private and public debt. So I'm just missing the private market reaction to, I mean, these huge infusions that we have seen, plus now a huge extra infusion through the reconstruction bond issue, which is a different mechanism going towards a little bit of a fiscal union, as you also mentioned, which the ECB has been going towards in different steps through the ESM creation and so on and so forth. So the ECB has, and the financial system of the ECB has evolved a lot. And so I think that it will not evolve further through the problems that will arise. And by that token, I don't see that this little question of managing a margin can sort of exhaust what will happen. So, so I'd like to hear your response to that.
I mean, I don't think that, I mean, the central banks can have everything, and we must hope that the central banks solve all our problems. But it's a point that now the quantitative easing programs are made up to target the yield curve, all the yield curve, without explicitly saying that, but they are doing that. They are doing this kind of policy. They are trying to control interest rates, not just at the short-term market, but along the yield curve. So it's not a matter of we need to do it or we not need to do it. They are doing it. My point is, you need less central bank's balance sheet expansion, so less balance sheet intervention if you have yield curve control, not on all the yield curve, on some particular portion of it, and in some particular moment, not always. But for example, for cleaned balance sheet of banks that are full of junk assets, yield curve control maybe is not the best policy. You need quantitative easing. You need asset purchases. So I think that the best description is a contingent policy in order to mix three different tools of the central banks: forward guidance, quantitative easing, and the floors and the floor and ceiling system. But again, you don't have to use it every time, always, for every problem. I mean, for now, I think that I think that they are going this way. I mean, the Federal Reserve is talking a lot about this. I think that the Reserve Bank of India, I'm not sure it's called Reserve Bank, but the central banks of India is now targeting the yield curve. And even for the European central banks, there are a lot of discussions about these topics. But again, I think that central banks will arrive at a certain point at the conclusion that they can target the yield curve at a certain point in a certain moment at a certain portion of the yield curve. So the point is how to do it. The point is how to build a narrative that will be accepted by the government of the Eurozone and all the streams in the European central banks, because we know that they are not a unique corpus, but you have different kind of streams inside the European central banks, with the hawks, the doves, and the other kind of policy streams. So again, I think that, I mean, my proposal for the ECB is just an idea or how to European Central Bank can use imagination, can use tools in order to deal with problems. But it's not just, okay, the central bank can solve all our problems, because it's not. It cannot.
Very, very nice the discussion. I think we have some things on the chat. Robert, do you want to make a comment? And also Gita also wrote something here.
Yes, I wanted to underscore what Francesco just said, that an approach that ends up with a smaller central bank balance sheet is probably to be preferred. Stuffing all these bank reserves into the banking system, even if we exempt them from capital requirements or leverage requirements, is really not a good thing to force all of these assets onto the banking system and absorb the safe assets, the tradable assets, the collateral assets from the financial system. These are basically bad side effects of quantitative easing through buying government securities. But I would underscore the point that Francesco made before. It's tricky to exit, as the United States saw with the Treasury Fed Accord.
I mean, if you look, for example, at Australia and how it managed this yield curve control, you see that, for example, there is this interesting article in Bloomberg that shows the balance sheet of the Reserve Bank of Australia and the Central Banks of New Zealand. The Central Bank of New Zealand used a quantitative easing program, and they continue to buy months and months after the beginning of the pandemic, while the Reserve Bank of Australia at a certain point stopped to buy because the market internalized the price, and they basically say, okay, there is no way in which we can fight the central banks, so stop fighting it and just trade at the price that they want. So basically, this is a good point. I mean, I'm not for large central banks intervention because central banks can solve everything. We need less central banks intervention and bold action by the central banks. So, for example, I think that there was an article in August, I think, or in June, that proposed that for the ECB, the issue of euro bills. So basically, was the same of the treasury bills in the USA, but for eurozone issued by the European central banks in order to fix the yield of government bond at a particular level, because basically the central banks can exchange these euro bills with government bonds and basically put a floor on the price. So the point with, I mean, for what I understood, the point with central bank, it's bold action without caring a lot on, okay, we can do this because we can this policy because our balance sheet will grow too much. If you need to let your balance sheet to grow too much, you have to do it, because otherwise all the system will collapse. But if you can have commitments on the yield that will enables you to have less purchases, you must do it. I mean, you can have more political, more balance sheet space to do other things, or to let basically the market adjust alone to your policy. So again, I think it's a point to understand what are the better tools to intervene in the market in some particular moment, in specific moment.
Thank you, Francesco, for the comments, and thank you all for the great discussion. I'm sad to have to close it. It was really enriching, and I wish we could move forward, and we will move forward with other gatherings like this. So I'll just hand it off to Jay so he can do the closing of it. Thank you again, all the three presenters and all the discussants.
Thank you.